All right, let's jump right in. The crypto market, wow, it can feel like a total roller coaster, right? One minute there's all this crazy hype, the next, it's just pure fear. But what if you could swap all that emotional chaos for a clear, repeatable process? Well, that's exactly what we're going to do today. We're building a solid framework to help you analyze any crypto project like a seasoned pro.
Come on, be honest. Have you ever been here? You see a coin just shooting for the moon, that FOMO kicks in hard, and bam, you buy in right at the very top. Then the market turns, panic sets in, and you end up selling for a loss only to watch it rebound a week later. It's such a painful cycle, and it's driven 100% by emotion, not by strategy.
But there is a much better way to do this. The best antidote to emotional investing is having a logical process. When you have a clear, step-by-step framework, it just removes all the guesswork, it helps you make decisions based on actual data and reason, not just whatever's trending on social media.
So here's how we're going to break it down. We're going to build this framework in 4 key parts. First, we'll lay the foundation, which is all about you and the core idea of the project. Then, we'll pop the hood and look at the engine, the team, and the token's economic design. After that, we'll hunt for proof in the technology and its adoption. And finally, we'll get to execution, turning all that research into a smart, actionable trading plan.
Okay, Section 1, the foundation. Now this might sound a little strange, but the very first thing you need to analyze isn't the cryptocurrency, it's yourself. Seriously, before you can even think about evaluating an asset, you have to be totally clear on your own goals and what the project is actually trying to do.
So look at the difference here. On the left, that's the emotional path. It's pure chaos. The strategic path on the right, though, that starts with a really simple question. Who are you as an investor? What's your time frame? What's your actual risk tolerance? I mean, could you stomach an 80% drop without panic selling? Answering these questions first helps you filter out all the noise and is your #1 defense against making those big emotional mistakes.
So, once you know yourself, then it's time to dig into the idea itself. And the best way to do that is to ask some really direct questions. What problem is this actually solving? Who really needs this? And here's a big one. Does this whole thing even need a token to work? And my favorite test, if you can't explain what the project does in one single clear sentence, you probably don't understand it well enough to put your money into it.
Now let's move on to Section 2. This is the engine room. This is where we look at the 2 things that really give a project its power: the people who are building it and the economic rules that make its token tick.
An idea is just an idea without execution, right? And that all comes down to the team. So, are they public? Are they hiding behind some anonymous cartoon profile? Look into their track record. Have they built successful things before? And pay really close attention to the community. You want to see real, active, smart discussion, not just a chat full of Win Lambo comments. You just can't fake real engagement. Next up in the engine room is tokenomics. Now, I know it sounds like a complicated word, but it's really just the economics of the token. It tells you how many tokens exist, who gets them, and what you can actually use them for. Trust me, understanding this is absolutely crucial for figuring out the long-term potential of a project. And one of the biggest parts of tokenomics is distribution. In other words, who owns all the tokens? You got to find out how much of that pie is going to the team and the early investors. If they own a giant slice, you have to check their vesting schedule, which is basically just a fancy term for the timeline of when they're allowed to start selling. A huge wave of insider tokens hitting the market can create massive selling pressure and just tank the price for everybody else. And really let this one sink in. You could have the most revolutionary technology, the most brilliant team on the planet, but if the tokenomics are garbage, if there's always more tokens being printed or insiders are constantly dumping, the project can be doomed from the start purely because of that selling pressure. Okay, on to Section 3, proof. So we've looked at the idea, we've checked out the engine, now it's time to find some hard evidence. Does the tech actually work? And maybe more importantly, is anyone actually using it? Talk is cheap. Proof is everything. So here are 4 super practical ways you can check the tech. First, has the code been audited for security flaws? You want to see that done by a well-known firm. Second, is the team actually building anything? You can check that on sites like GitHub to see if developers are constantly working on the code. Third, look at their roadmap. Is it realistic? And finally, just try it out yourself. Is the app even usable? Clunky, awful tech is a massive red flag. And this is what real adoption actually looks like. Forget about vanity metrics like how many followers they have on Twitter. The true story is always told on the blockchain. You want to be looking at things like daily transactions or the number of active wallets. A project with steady, growing on-chain activity is showing you it has a real user base, not just telling you.
And that brings us to our final and most important section, execution. This is where the rubber really meets the road. You've done all the hard work, you've done the analysis. Now you need to create a disciplined plan so you can act on it.
And let's be super clear about this. All the research in the world is completely worthless if you don't have a plan. You have to know when you're going to buy, when you're going to take profits, and when you're going to cut your losses before you ever invest a single dollar. If you don't have a plan, you're just going to fall back on those same old emotional habits.
And look, your plan can be as simple as this. Before you ever hit that buy button, you need to write down these 4 things. What's the price range where you're willing to enter? At what price will you take some profits off the table? And this is the most important one. At what price will you admit you were wrong and just sell to protect your capital? This simple exercise is the absolute key to disciplined investing.
And that's really what this all boils down to. When you follow a structured process, from understanding yourself to vetting the idea, the team, the tech, and finally building a solid plan, you replace that feeling of panic with a sense of clarity. And it's that clarity that's going to protect you from making those really painful, costly mistakes.
So, I'll just leave you with this one question to think about. When you look at your own investments, are they the result of a disciplined process and careful analysis? Or are they built mostly on hype, hope, and that fear of missing out? The answer to that question could change everything for you.